Hello everyone and welcome back. So my name is Give Moma Goju, and we are going to build the debt schedule for Simbisa Brands in this section. So the reason why we built the debt schedule at the end is because of what is called or what is known as circular references. So circular references can make it difficult for us to work with our model if we invoke them at an early stage. So that's why we resorted to building the debt schedule at the end. And the debt schedule as well is also important for you as an analyst to be able to analyze certain situations or scenarios. For example, we all know that a company is funded by a combination of equity and debt. So your superior may at some point ask you to assess whether it is feasible for a company to raise debt given given certain conditions. So let's say you have built up your model and now you get to this part. After you've done all your projections, all your assumptions you've come up with, you now need to assess whether it is feasible for a company to raise it. Then you build the debt schedule so that you can track for the debt issuances and repayments at certain dates and certain years, and be able to advise the client or your superior accordingly. So without wasting time, let's dive right into it. Now, so what is important for you to understand in this section is we have got if you go to the balance sheet, you'll see that we have got the long-term debt, we've got short-term debt, we've got long-term lease liability, and we've got short-term lease liability. And here I've got historical information. Okay, so the interest income that we find in the income statement is from short-term investments by Simbisa, right? Simbisa Brands. Simbisa might be investing in short-term financial assets, be it in the money market. So, and also the long-term debt. So, what is not quite what is not quite clear in the annual report is the interest rate for long-term debt and short-term debt. So, I just computed the total interest rate for both short-term and long-term debt, and the lease liability for both short and long-term. So it's not that clear, that information. So we have to dig deep to find out the actual information, and then we can come and change that. So for the time being, let's just proceed building out our debt schedule. Now here we want to so here, let me just close this. So here we want to link the end. So what is most important is the here we are going to link the cash balance for 2023 from the balance sheet. So here, so the end of year, the 2023 balance becomes the beginning balance for 2024. So here, so I have to come back, and then I have to link that through. Okay, and also cash flow before debt paid down. So I have to link that from the cash flow statement. You can see that here we've linked that through, so I can link that through. So minimum cash cushion, I can just add just 1 million. This is just, we are saying this is the minimum cash that Simbisa has to have, just for working capital purposes and stuff. So here we can just sum up that. Right, so we can sum up that, and then we can copy that to the right, and we can proceed to short term. So short term, we are saying for short-term debt. So short-term borrowing balance for 2023 becomes opening balance for 2024, right? And we don't have information about issuances and repayments for now. So what we do is we just add that and then copy that, just like that. And then here we do the same. We link the short-term, this liability, from the balance sheet, like that. And then we link it again as opening balance. We don't have information about issuances and payments as of yet. So here we can copy that, and we can copy these balances here, and we can copy that as well. And we can do the same here, long-term borrowings. So we can take the balance for 2023, and we can also link that as 2024 balance, and we can put new balances there. Right, and then we can copy that to the right, just like that. And let's finish off here, and we can link that for the long-term lease liability balance here. That's right, and then we can copy that through. Right, perfect. So here we have to add all issuances. So here plus this, plus this, plus this, plus this, plus this, plus this. Perfect. So we can copy that to the right, and right. So here the closing cash balance will be this plus this plus total issuances. Perfect. And then we copy that to the right. Okay, and then we can copy that as well to the right. Perfect. Right. Now, like I showed you, the total interest that I computed. So let me just first add some top line border there. Some top line border. Right. Okay, I think we can leave that as is. Right. So the interest rate that we are working with today is for 2024. That's 24% throughout. Okay. That's the same we are also using here. So that's 24%. And here that's 13%. 13%. And what else? 13%. Do we copy that to the right? Okay. And then the historical income rate that we got, historical. So here we have got interest income, short-term bank deposits, this is okay. So this is interest income, short-term bank deposits. So the best way here to compute the historical one is to say, to average that, to divide that by the average cash and cash balance here. So I'm going to just divide that. Then we can see that that was 8%. So they were getting 8%. That's the interest, 8%. So here we can choose to put it 8% for now. Then we can be able to change these ones once we gather more info. Right. Now we need to compute the interest expense. So to do that, we say average times the interest rate, and then we copy that to the right. So here we say average times, and then we copy to the right. Average, okay, average times 24%. Do we copy that to the right? Then average times, and then we copy that to the right. So here we sum all these expenses. So say plus, and say plus, say plus, and you say plus. Okay. So we copy that to the right. Okay. And we do the same here for the interest rate. So we multiply that by 8%. Okay. Is 8%. So we're saying this is a bit too high. So let's just put it at 4%, which is half of 8%. Okay. So before we link this through, so now we are done with the debt schedule. Before we link that to the income statement, we need to project the allowance. Okay. So what we are doing is we are saying allowance for credit losses is a percentage of receivables. Okay. So what we are doing now, let's just correct our formulas, and then we say plus. We close that. Right. So what we are doing now is we are saying so here we are saying this average. So we go to the balance sheet, and then we divide it by average receivables. Okay. So we change that, and then here let's just put it maybe so we can just change that. So here we can say 1.3% of that. Okay. So the way we are doing it now is we have to say this we have to say this multiplied by, since we started with average, okay, so average, we go to the balance sheet again, and then we say average receivables like this. Okay, since it's not working out, okay, let me just try to let me just say this times average. Maybe let me just try here, times average, what do you call it, average receivables, so like this. That's perfect, and then we can copy that through. Okay, so if we audit our formula here, we see that our formula is intact, so that's okay. So that's okay, that's okay. So here, this figure here, we have to change, right? So we have to, and then we have to link that through from the cash flow statement. Okay, so let me just control 1 so that I turn that into, okay, which is control, and then perfect. Okay, what else? So here I have to link the interest income. So to link the interest income, what I'll do is I'll just equal, then I'll go to the debt schedule, and then here I'll link that. Okay, so now you see it's not allowing us to link anything and stuff. So this has to do with circular references. So go to file, and go to options. So file, options, and go to formulas, and then go to enable iterative calculation. Okay, so 100, or you can move that, you know, 100 to 100 is fine. So we can say okay. So you can see we have been able to link that. So now let's link the total interest now. So total interest, we linked it, perfect. So now you see our margins are now coming back, and if we go now here, we can link interest income, say negative, you can link it from the income statement. So here, this is interest income, let's see here, let's see, we are saying this is interest income, so interest income, so like this, which is fine. And then here we have to link as well interest expense, and then we copy that, and then we have to come again here. Okay, we have to come again here, and we have to link that. We have to link that interest income, we have to link it again, perfect. We have to link it here, and we also have to link this here, perfect, just like that. So now we are done linking that. Okay, so here, like I said, income tax paid, we can compute that later. but for now we can just put it at 0. Okay, right. So which is fine, right? So here we can also proceed to just put some, so we can go back to the debt schedule, right? So here what is important is, let's say the company says it wants to raise debt, new debt in future. So let's say it's a mandatory issuance, right? So let's say it wants to raise maybe about 3 billion debt, okay, 3.5 billion debt, or 3 million, okay, like this. So and then maybe wants to repay, maybe we'll repay 500,000 here. So you can see that changes, okay, and you can see that this, if we go to the cash flow statement, right, so if we go to the cash flow statement here, so the proceeds should have been, what do you call it, proceeds from borrowings, repayment. Which ones did I link here? So lease, repayment, principal, this one I remember that was. So here in the cash flow statement we can link from the debt schedule, right? Let's say this was actually labeled like short-term, long-term, and lease liability short-term or long-term. We can link from the debt schedule so that all the flows, they are reflected through the cash flow and also the balance sheet. Okay, so even if we come here, you will see that our balance sheet still balances, right, which is also great. So basically that's it. So in the next section, I'll also in another series I'll also show you how to link that with the debt schedule as well. But basically you can track how the interests are changing even here and how it's affecting the earnings per share, something like that, so that at the end of the day you can make a decision whether because raising debt has got an anti-dilutive effect, whereas raising equity, it dilutes the shareholding. So you have to make decisions based on that. Now I think we are done building the financial model for Simbisa Brands. This is right, this is it. So I hope you have enjoyed it and that you have learned a great deal. So see you in the next section where we are going to look at valuation.